Imagine you're sitting with me in the trading room, maybe early morning, screens warming up, markets still calm before the opening bell. I'm Isabel Maria, and today we're going to talk about one of the most enduring and battle-tested approaches in trading, trend following. If you've been around markets long enough, you know price has a way of revealing what's really happening under the surface long before the news cycle catches up. And this is where trend following earns its reputation. It's a strategy that cuts straight through the noise and focuses on the only thing that ever pays you, price movement. When new traders come into the market, they usually try to predict reversals. They try to buy bottoms and sell tops because it feels clever. It feels surgical, like they're outsmarting everyone else. But there's a reason seasoned traders smile politely when they hear that. Tops and bottoms are the least stable places in the entire price structure. Trends, on the other hand, are the market's way of expressing consensus, capital flow, macro direction, sentiment, policy effects. When something is trending, it is doing so for a reason, whether or not you see that reason clearly. And your job as a trader is not to outthink the market, it's to participate intelligently in what it is already doing. Trend following rests on a very simple but profound truth: markets move in waves, and these waves can last longer than anyone expects. I have seen trends that lasted days and trends that lasted years. I've seen traders fight a trend for weeks, blow their account, and only then accept that the market wasn't wrong, their ego was. The beauty of trend following is that you are always aligned with the path of least resistance. You are not forcing anything. You are simply reading the direction of price and positioning yourself where the momentum naturally carries you. The mechanics begin with identifying the trend itself. And although it sounds trivial, this is where beginners usually get lost. Because trend identification isn't about drawing a line and hoping it sticks. It's about consistency in how you interpret structure. You want to train your eye to recognize higher highs and higher lows in an uptrend and lower highs and lower lows in a downtrend. But to avoid subjective bias, you reinforce your interpretation with objective tools. This is where moving averages come in, and they have served traders well for decades. The 50-day and 200-day moving averages are classics for a reason. They smooth out the noise, they give you a visual anchor, and when you get a crossover between them, it often reflects a meaningful shift in market regime. When the 50 crosses above the 200, many traders read it as confirmation that momentum is shifting bullish. The inverse signals bearish momentum. But trend following is not about reacting impulsively to the crossover. It's about understanding what a crossover represents: institutional flows, multi-timeframe alignment, a broader shift in how buyers and sellers are interacting. If you prefer something more reactive, the exponential moving average gives you faster responsiveness. That can be useful in markets that accelerate sharply or correct more violently, because you're not lagging behind the curve. Complementing this, indicators like RSI and MACD help you gauge not just direction, but strength. RSI, when used properly, isn't about calling overbought or oversold to fade the market. It's about reading whether momentum supports the trend. A strong uptrend can live comfortably above RSI 60 for long stretches of time, and beginners often exit too early simply because they misinterpret strength as exhaustion. MACD tells you about trend momentum and potential acceleration or slowing down. And then you have ADX, which is like your truth detector. ADX doesn't care whether the trend is up or down, it cares whether the trend exists at all. High ADX means the market is trending with conviction. Low ADX means you're dealing with chop and should probably step back. But indicators are not the strategy. They are instruments. The strategy is discipline. Every trend follower eventually learns the emotional side of this game. Trends test your patience. They move slowly at first. Then they accelerate right after you doubt them. Then they pull back sharply just to see if you really know what you're doing. Trend following is a psychological workout because the money doesn't come instantly. But when it comes, it tends to come in chunks. You spend long stretches waiting, positioning, managing risk, and then suddenly you're in the middle of a smooth, unstoppable run, and you understand why trend followers stay loyal to this approach. Let me bring this to life with Emma's story, because it captures the evolution many traders go through. Emma started the way most beginners do, short-term, reactive, jumping in and out of trades trying to capture tiny movements. She was constantly being shaken out. She exited winners too early. She held losers too long. She chased noise instead of structure. And the frustration built to the point where she realized she wasn't trading, she was gambling under pressure. When she shifted to trend following, it wasn't because she suddenly became patient. It was because she hit the wall where the old way simply wasn't sustainable. So she took a structured approach. She leaned on moving averages to avoid subjective interpretation. She used the 50-day and 200-day cross to identify trend direction. She used RSI to confirm momentum so she wouldn't enter into something stretched. She used MACD to validate that the shift was real, not a flicker. And most importantly, she committed to risk management. She limited each trade to 2% of her capital. She set stop losses. She refused to add to losers. She journaled her decisions so she could study her behavior, not just her charts. Everything changed when she stopped trying to be early and started focusing on being aligned. One of her most illustrative trades was in a tech stock that began trending strongly after a long period of consolidation. The 50-day SMA had just crossed above the 200-day. RSI was strong but not overheated. MACD was widening in her favor. Emma entered at $100 with a trailing stop 10% below the entry. And then she did the hardest thing in trading, nothing. She let the trend unfold. For 6 months the stock climbed steadily. There were minor corrections, little pullbacks that would have panicked her in the past, but she stayed focused on structure. Higher highs, higher lows, trend intact. Eventually the stock hit $150. Her trailing stop moved up accordingly, and she was stopped out at $145. In that single trade, she made more than she had made in months of frantic short-term scalping. And the lesson burned itself into her system: trends pay, noise distracts. Emma also had losing trades. Every trend follower does. Sometimes a crossover fails. Sometimes momentum evaporates faster than expected. Sometimes news breaks the structure. But the difference was that her losers were controlled. Her risk was capped. She preserved capital. The mathematics finally tilted in her favor because trend following isn't about winning constantly, it's about catching big moves while ensuring your losers are small enough not to matter. Over the course of a year, her consistency stabilized. Not because she became a genius, but because she became disciplined. And that's the heart of trend following. You're not predicting, you're aligning. You're not forcing the market, you're partnering with it. You're developing the patience to let structure unfold and the humility to accept when structure breaks. As Seykota famously said, the trend is your friend until the end when it bends. That phrase survives because it speaks to the reality we all face: you ride the wave, but you respect the turn. When you take this approach seriously, your trading transforms. You stop fighting the screen. You start listening. You internalize the rhythm of the market. You give trends the room they need to develop. You learn to sit on your hands when the market is choppy, because no trend follower thrives in chop. And over time, you develop a professional mindset: you don't need to trade constantly, you need to trade effectively. Trend following is powerful because it is simple, but it is not easy. It requires discipline, risk control, emotional management, and patience that most traders underestimate. But when you commit to it, the learning curve becomes incredibly rewarding. You begin to see how capital flows shape price. You understand market structure in a deeper way. You feel the difference between noise and genuine momentum. And you start to trust your process rather than your impulses. Before we close this episode, I want to leave you with one thought to reflect on. When you look at your own trading journal or your own chart history, are you aligned with trends, or are you trying to outsmart them? Let me know in the comments down below.
Thank you for listening to the Ultimate Trading Podcast by Bells Forex AudioWorks. If you love this episode, hit follow, leave a quick rating, and share it with one trader friend. It really helps. Right now, head to bellsforex.com/tools. 6 professional-grade trading tools, 100% free, no sign-up. Use them on every trade. They're that good. Full guide is free at bellsforex.com or grab the Kindle version on Amazon. Until next episode, trade smart, stay disciplined, and keep building your edge. Happy trading!